For years, the conversation around Bitcoin was the same. Is it real? And does it belong in a portfolio? While others debated, CoinShares got to work. In 2015, they launched the world's first Bitcoin ETP, regulated, listed, and built for institutional investors. Long before the U.S. market caught up. Today, they manage over $6 billion in assets and have remained profitable through every market cycle, including the 2022 downturn. What sets them apart? They're not a crypto exchange chasing trading fees, not a company betting its balance sheet on Bitcoin, not a mining operation. CoinShares is an asset manager with recurring fees, a fixed cost base, and a business model you can actually model. Now listed on NASDAQ under ticker CSHR. Learn more at coinsharesipo.com.
When you're running a business, the best days are the ones where priorities stay on track. For midsize and large companies, that isn't always easy. Risk can touch multiple parts of an organization at the same time, often in ways that aren't immediately obvious. It might involve property, liability, or cyber. It could stem from regulatory requirements or challenges tied to a specific industry or the scale of an operation. At that level, managing risk becomes an ongoing discipline, not a one-time decision. At The Hartford, the focus is on helping businesses manage risk before it turns into something more disruptive. That means working with companies to identify where they're exposed, decide what matters most, and put practical standards in place so risk is managed as part of day-to-day operations. And when losses do happen, The Hartford can pair that risk control work with insurance coverage grounded in underwriting, risk engineering, and claims experience developed over time. Learn more at thehartford.com/risk mitigation.
Being a small business owner isn't just a career, it's a calling. Chase for Business knows how much heart and effort go into building something of your own. Manage all your business finances, from banking to payments to credit cards, all in one place with Chase's digital tools. Plus, access online resources designed to help your business thrive. Learn more at chase.com/business. Chase for Business. Make more of what's yours. The Chase mobile app is available for select mobile devices. Message and data rates may apply. J.P. Morgan Chase Bank, N.A. Member FDIC. Copyright 2026. J.P. Morgan Chase & Company.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
Focus is on Netflix, just out with its latest quarterly results. The company beating estimates, though. Reed Hastings, of course, one of the co-founders, is stepping down from the board after 29 years to pursue philanthropy and personal interests. But again, we should point out, in terms of the company, we can talk about that in just a moment, did report revenue that beat analyst estimates in the first quarter, buoyed by strong subscriber growth, engagement, keeping subscribers there and bringing them in. That's important.
The guidance, though, is what has people concerned. Second quarter earnings per share of 78 cents is what Netflix is guiding for. The estimate was for 84 cents. I want to bring in Geetha Ranganathan, Bloomberg Intelligence senior media analyst. She joins us from Bloomberg Intelligence headquarters in Princeton. Geetha, there's two elements that we want to talk about here. One is the light guide that disappointed analysts, but also Reed Hastings moving away. Which one is a bigger way on the stock in the after hours?
Yeah, thanks so much, Tim. And it's definitely the lighter guidance. So I think not only were we looking at the second quarter guidance, which of course is lighter, both on the revenue side as well as on the EPS front, but we were also anticipating some kind of a take up for the full year revenue guidance. So remember, the quarter before they had said 12 to 14% for the full year, and they basically just came out this time and reaffirmed that same number. And I think the street was really looking for all the recently implemented price hikes to contribute to maybe at least 100 basis points of improvement in revenue growth. The same goes for operating margin. I mean, when the guidance first came out for operating margin at 31.5%, that was considered to be pretty muted, and I think the street was pretty disappointed last time around. And they continue to be pretty. I think they're still kind of taking a conservative approach, but definitely the street is going to be pretty disappointed on this.
So what do we want to do? Does everybody want to push them on the call with analysts to say, wait, give us a little bit more color around this? Are you being conservative? Is it as easy as that, Geetha?
So I think there are a couple of different things here happening, Carol, especially with the second quarter. So the reason why their revenue guide fell a little short of analyst expectations was because they did implement a big price hike in the second quarter of last year. So they're obviously lapping those increases. So that's one thing to kind of keep in mind. And then the second thing is on the EPS front, and the reason why we're seeing a little bit of pressure in terms of guidance for EPS and operating profit is because they do expect very, very heavy content amortization in the second quarter. So, they think that will ease a little bit in the second half, but in the second quarter, it's going to be pretty heavy, which might be part of the reason why they're still kind of taking a little bit of a conservative stance. And, we've seen them kind of really invest in a lot of different pieces of content, most notably sports, whether, it was the MLB opening day game or the World Baseball Classic, and you have a couple of boxing matches coming up. And so I think with all of that, they're kind of taking probably a slightly more measured, cautious tone.
We don't get actual subscriber numbers anymore, unfortunately, but the company, as you mentioned, boosted its standard plan without ads by $2 to $20 a month. That was in March. Any indication based on these numbers or doing some quick back of the envelope math, what that did in terms of churn or maybe pushing people to the advertising tiers that are less expensive?
Yeah, so historically, Tim, what we've seen is, and we've seen this in multiple price increases that Netflix has done over, the past 4 years or so, is that churn has been pretty low. It is actually, for Netflix, it's actually the lowest across the board. It's about 1.7%. You compare that to about 6 to 8 to 9% for some of the other services. So they've historically seen very, very low cancellation rates. Of course, there is the possibility, with the price increase that there could be a little bit of tearing down, as you just pointed. I'm not sure it necessarily had a huge impact, at least for the quarter that is reported, but maybe they are factoring in some of that for the second quarter, which is why we're kind of seeing that lighter than expected guidance in terms of revenue growth.
Okay. I mean, listen, I feel like, when we talked about Netflix, right, in the last how many months, the story that gave over the past year was Warner Brothers Discovery. I mean, is there any rethink that was a mistake or now? That has nothing to do with what we're seeing here.
So you bring up a really interesting point, Carol. And I think, when they announced the deal, people were kind of, flummoxed, and they were like, why are you doing the deal? Is it because you need it, or is it just a nice to have? Is it because this is, a once in a generation, once in a lifetime opportunity for you guys to get hands on an asset that will probably never again come to the market? What is it? And I think, people were kind of looking at this first quarter report as, providing some more answers to that. But I think we have more questions than answers at this point, because we're not necessarily seeing a great acceleration in the revenue numbers, in the operating margin numbers, which is exactly what they needed to show in order to basically assuage investors that it did not need Warner Brothers Discovery. So this kind of it kind of leaves investors, I think, a little bit hanging a little bit.
What about the Ben Affleck acquisition?
That is a great acquisition. So, and I think we will continue to see more of this going forward. So that is, I think as we kind of ponder about whether AI is going to be a positive or a negative for some of these media companies, I think we're definitely going to see Netflix kind of flip the script and be more of an AI winner. And that, the Ben Affleck company Interpositive acquisition, which was basically for $600 million, I think it's a really smart, disciplined move, which again helps them really kind of hone in on AI and make it, make it a positive catalyst.
But there's this balance that, and maybe the Ben Affleck element helps because he is a creator. He's a Hollywood creative, more so than an executive. But the scary thing is, I think for a lot of people in Hollywood is like, what does it mean for their own jobs? And is it existential if AI can do what they're doing?
Yeah, and I think, Netflix has said this many times, and just the fact that, Ben Affleck is obviously, he represents Hollywood and the creative community. I think the company itself is really more about offering creators better tools for storytelling. So I don't think it's necessarily replacing them. And that's the same story that Netflix obviously has been saying too. This is just to help them do their jobs better. This is not necessarily to replace them. So we'll see how it all, it's still early days, Tim, and we'll see how it plays out. But, so far they're, saying the right things, I guess.
20 seconds. The company's going to be okay with Reed Hastings off the board?
I think so. I think he's kind of been in the background now for a while. It's really just been Ted Sarandos and Greg Peters running the show, and I think they will be fine.
All right, cool stuff.
I want to bring in Eric Clark. He's Accuvest Global Advisors CIO. He's also the portfolio manager of the Logo ETF, which has Netflix as its second biggest holding. He joins us from inside for some reason, even though he's in beautiful San Diego, California. Eric, thanks for going into the office today to actually talk to us. Do appreciate that. We want to just get your quick reaction on Netflix, down 9% right now. Carol mentioned some of the headlines. The light guide certainly has investors a little concerned. Reed Hastings stepping away. A big deal, but maybe not as concerning to investors. What's your quick reaction?
Well, Carol said it earlier. The stock's up 40%. I mean, it went down 40% from the highs in September, and then it went up 40% or 42% since the lows at $75. So, short term, any stock that runs 40% into an earnings print better be an absolutely perfect print. But we don't care that, short term noise in a quarter has never bothered us. It's as long as the dominant theme of any company is still intact. You ride through some of the noise quarter to quarter and you take advantage of that. And the stock was down 40% and we added to it a number of times to beef the position up pretty meaningfully because we do believe in this long term and we've been getting paid to do that. So sometimes you just have to be willing to look through short-term noise. And we did come hot into the print.
Yeah, listen, I think based on, was it the end of last year? This looks like it's the number 2 holding in your ETF, the Logo ETF, roughly 5.8%, but you can correct me. You're going to add to that position, or is this kind of near the top of how much you want in the portfolio?
Well, by flexibility, we can go higher. I don't know that, on a small print, on a small pullback like this, I don't know that there's a reason to add to it. I think the goal is that there's been a lot of names that have come down. There's been a lot of turbulence under the surface. So we have a pretty full position in Netflix. Sometimes we trade around it. So, if I got the opportunity to do that, I could certainly do that. But, our goal is to find what are the next $1 trillion brands? Who else joins the $1 trillion club? Mm-hmm. Walmart joined not long ago. And, Netflix only has to do about 13% revenue ongoing and generate good free cash flow. We even cap the margin assumption at 35%. We cap the content spend at $20 billion, driving some more share buybacks. And you get to $1 trillion in market cap in 2032. So big picture, there's a lot more upside to go. You just have to go through different, noisy quarters in a market that can be volatile.
That's a more than doubling of the market cap in the next 6 years. You think that happens?
I do.
Without Warner Brothers Discovery?
I don't know. I completely agree. I think it would have been great to have that big content library. But, again, at what cost? That they've just saddled Paramount with a pretty significant debt load. So they can do lots of other things on the content spend. They're going to clearly do more on sports. The gaming is probably more of a free call option, I think, going forward. It's a little hard to know, how that's going to go. But if they just do what they've continued to do, ratchet up margins a bit, use AI to enhance the business, draw viewership in, Netflix is still the benefit of it's the place we go first for content search. And then we go out from there. Well, there's nothing new on Netflix. Okay, now I'll go to HBO. Okay, now I'll go to Amazon or Apple. So there, and at $27 a month, it's still an incredible value to the average consumer for all the entertainment that you get. And obviously, I do agree. We have an $8 billion revenue estimate from the ad tier in 2032. And I think your prior guest was talking about somebody having 10 billion. So I think there's just a lot of things that a lot of levers to pull for Netflix on the free cash flow, on the margin, on the AI side, which is still a little bit of an unknown. So I think dips are to be bought here.
Go ahead.
No, go ahead.
Well, Reed Hastings, he has Powder Mountain in Utah. He's off skiing and creating this. David Weston got to go to Powder Mountain last year and talk to Reed Hastings. I would like to do some skiing at Powder Mountain.
I bet you would.
An issue at all for this company that Reed Hastings, and look, he hasn't been CEO or co-CEO for a time at this point. Not an issue to you that he's exiting the board when his term is over?
not an issue at all. And he still has $2 billion worth of stock. So he's pretty vested in keeping up with Netflix and being comfortable enough to walk away while still having, last I checked, 21 million shares. He's committed to Netflix success, similar to Ballmer with Microsoft success. And look how it's worked out for Steve Ballmer with all the things that he's done with Microsoft stock.
I should note, I do believe Reed Hastings is a board member of Bloomberg LP, the parent company.
He is.
Of Bloomberg Radio and Bloomberg Television. So full disclosure there.
Yeah, no, we like to do that. Having said that, all right, so let's talk about the folks that are behind the helm. And let's just remind everybody, first of all, we're talking to Eric Clark, Accuvest Global Advisor, CIO. He's also a portfolio manager of the Logo ETF. Netflix is the second largest position in that ETF. Right now, we're looking at Netflix shares continuing to trade near their lows in the aftermarket, down about 9%. This is after the company's revenue did beat estimates. We did have that in the first quarter, but revenue did go up 16% in the first 3 months of the year to $12.3 billion. That was a slight beat. Earnings per share, $1.23 compared with estimates of 76 cents. In the current quarter, though, the company forecasting earnings per share of 78 cents a share. That's less than the 84 cents predicted by Wall Street analysts. So that is the backdrop for those earnings. We're headed off to the analyst and investor call in a little while. Eric, what do you want to listen out for? What would you want to be asking on that call? You are an investor in the name. What would you be asking of the co-CEOs and their C-suite team?
Well, I think sports and they're obviously not going to give you a ton of clarity or granularity on sports because they don't want to tip their hand. But it's clear that sports has been a very big win for them. So I expect them to talk more about double downing on those kinds of differentiated opportunities and just, trying to be as mindful about their spend and the quality of the spend is really what I would ask. Because, let's face it, for a while there, they were in fill the library up mode and people kind of critiqued some of the quality content that they created. Now they have the ability, they have a large library. Now they have the ability to really focus on quality content, which certainly drives a lot more viewership and engagement. So again, at $27 a month, there are very few other services that give people more delight and more entertainment. And so there's just, and the business is so predictable and consistent. If in the last couple of months, every day the market was down with some of the Iran headlines. Netflix and Spotify were usually up on the day because of the stability of the business model. So it isn't just the growth that we are making it such a big weighting. It's the stability of the model that is important too. You're just going to have some of this volatility on the earnings.
Yeah. But what's interesting is we're in an environment, when I think about the model, YouTube, dominant global video program, roughly 2.74 billion monthly active users as of early 2026, leading U.S. TV streaming with over 12% of TV viewing time driven heavily by users over 50. Daily viewership includes 70 billion shorts views. Top creators, we can get into that. But this is from Nielsen. But people are watching YouTube, and I realize it's an older or skewed older, but I just wonder, do the streaming models, do they have it right? Well, and to be fair, they have a lot of people watching. I watch them. But I just wonder, what is the model of how there's so much coming at individuals. They have a lot of choices out there, or they could just, turn off their laptop, turn off their TV or whatever, and put down their phone.
Well, I think, we have this short-termism in a variety of our lives, this dopamine hit. And, YouTube does provide that short-term, I just want a 4-minute clip. And so it wouldn't surprise me if YouTube started or Netflix started to kind of experiment with some of those short burst type of content.
That's wild
as well.
Yeah. Isn't that funny?
That's so wild.
But you just think about, right? Because you click on those short videos. I mean, listen, I have someone at home that's really into it. And yeah, he's above 50. But I mean, the amount of stuff and velocity he will go through,
But whether Instagram, YouTube, TikTok, Snap, those short forms are everywhere.
Yeah, right.
But what do you think?
But he's not on that. But I just think about those short things, and you can have ads if you want. YouTube
YouTube copied YouTube now
Yes.
has YouTube Shorts, and they copied I think Snap, it's fair to say, kind of pioneered this, and then Instagram copied it. It's all over Facebook now. LinkedIn has this.
All I know,
It's everywhere.
I know. I just think about, how much YouTube is on in our household. It's pretty remarkable. So, all right. You're not worried, but you're not necessarily buying more here.
No, if we were at 2 or 3% weight, then I would absolutely be buying. But we have a full weight now. And if it pulled back a little bit further, again, we love to trade around names if we can get the opportunity. I'd certainly consider that as an opportunity, but I don't see us changing the core weight at 5% or so anytime soon, particularly with the assumptions that we feel pretty good about by 2032 with kind of joining the $1 trillion club, because that is a big part of what we're doing at Logo, trying to find the names who are the next firms to join the $1 trillion club. And that, there's a few on our list that look pretty attractive.
I want to go back to the AI question. We touched on this with Geetha a little bit as well. The Ben Affleck company, Interpositive, that Netflix announced it was buying back in March. Is Netflix doing the right thing with AI?
I think they are. I mean, AI is still, I think, an unknown to most of the world. So I think there's a lot of experimentation that has to occur. And if you are one of the lucky kind of companies that have a bunch of free cash that you can experiment with different things to try to see what resonates and then do a lot more of it once you have some good data, that just kind of distances your firm from all the peers. So I do think AI is going to continue to be a part of this, industry. And Netflix is in the catbird seat to be able to use their balance sheet to be able to figure out how to do it. And, we do expect good share buyback activity with they can do all the content they need with 20 billion or less a year, which means that the more they grow subs, the more they can buy back shares and reduce the float. And that helps earnings per share growth. And there's just a lot to like about the core business and a few things that could be, big optionality around the core.
Eric, really appreciate it. Eric Clark, he's Accuvest Global Advisor, CIO, Logo ETF portfolio manager, joining us once again from San Diego, as we've mentioned. Netflix, his second biggest holding in that Logo ETF.
For many men, mental health challenges aren't recognized until they've already taken a toll. Work pressure, financial stress, changing relationships, and traditional expectations around masculinity can quietly wear men down, often without clear warning signs. In Season 3 of The Visibility Gap, Dr. Guy Winch and his guests explore how these pressures show up, how to spot them earlier, and how men can access meaningful support. Listen to the new season of The Visibility Gap, a podcast presented by Cigna Healthcare.
These days, it seems like AI agents are just about everywhere you turn, every field and every function. But without identity, you can't trust they'll serve your business instead of jeopardizing it. Fortunately, Okta helps you get identity right by securing your AI agents' identities, giving you a single layer of control, a single standard of trust. So whether an AI agent supports a single user or your entire enterprise, with Okta, you'll turn risk into opportunity. Secure every agent. Secure any agent. Okta secures AI.
From coast to coast, unlock adventure at Red Lion Hotels by Sonesta, where restful sleep, friendly service, and trusted local knowledge are part of every stay. Red Lion makes it easy to feel welcomed, comfortable, and connected wherever the road takes you. Whether you're traveling for business or pleasure, you can spend less and make more of every trip. When you sign up for Sonesta Travel Pass, you'll get their best rates instantly. Go to Sonesta.com to book your stay and unlock the best rates with Sonesta Travel Pass. Here today, roam tomorrow. Join now at Sonesta.com. Terms and conditions apply.